Every time the Bank of Canada raises or cuts interest rates, it is following a set of rules, a framework that tells it what it is actually trying to achieve and how far it is willing to go. Most Canadians never see that framework. But today, the Bank of Canada published a report revealing what ordinary people and institutions said when they were actually asked about it. That consultation, and what it found, matters more than most headlines will tell you. The Monetary Policy Framework is essentially the Bank of Canada's operating manual for managing the economy. At its core is the inflation target, right now set at 2%, the midpoint of a 1 to 3% control range. Every 5 years, the bank renegotiates this framework with the federal government, and before doing so, it consults broadly. The report published today is the summary of that feedback process, capturing what Canadians said they want from their central bank. The framework is not abstract. When the bank decides that 2% is the right inflation target and not 1% or 3%, it is making a decision that determines how aggressively it will raise rates when prices climb. That directly sets the environment for your variable mortgage rate, your line of credit, and the borrowing costs for the businesses that employ you. In a country where housing debt is as large as it is in Canada, even small shifts in how the bank interprets its mandate can ripple into household finances for years. The bank reached out to stakeholders and members of the public and asked a fundamental question: is this framework working, and should anything change? That kind of outreach is relatively rare for a central bank, and the fact that the bank is summarizing and publishing that feedback is a signal of institutional accountability. Without overstating what the report alone can tell us, this kind of consultation typically surfaces tensions between what the bank prioritizes, controlling inflation, and what households feel on the ground, including concerns about employment, housing affordability, and real purchasing power. The 2% inflation target is the anchor of the entire system. When inflation ran well above that target in recent years, peaking at levels not seen in 4 decades, Canadians felt it acutely, at the gas pump, in the grocery store, and in rent. The consultation almost certainly surfaced questions about whether 2% is still the right number, whether the bank should tolerate more flexibility, and whether the employment side of the economy deserves more formal weight in the framework. These are not fringe questions, they are debated seriously among economists worldwide. One of the deepest tensions in any central bank framework is the trade-off between price stability and employment. The Bank of Canada's primary mandate is inflation control, but the framework also acknowledges that it should support maximum sustainable employment when inflation is well anchored. After a period of aggressive rate hikes, many Canadians who lost jobs or saw hiring slow would reasonably ask whether that balance was struck correctly. Consultations like this one are where that question formally enters the conversation. One area that often emerges in Canadian policy debates is the role of housing in measuring inflation. The Consumer Price Index captures some housing costs, but it does not fully reflect what it feels like to be priced out of a home purchase or to absorb a mortgage renewal shock. If consultation respondents pushed back on this, and this kind of move in public feedback usually reflects lived frustration with the gap between official inflation numbers and real affordability, then the bank will need to at least acknowledge that gap in how it communicates going forward. Canada is not alone in revisiting its monetary policy framework. The United States Federal Reserve completed a framework review in recent years and adjusted how it thinks about average inflation. The European Central Bank has done similar work. The timing lines up with a broader global reckoning after the post-pandemic inflation surge exposed the limits of pre-existing models. What Canada decides in its next framework agreement will be watched closely by markets and peer central banks alike. If the framework were revised to raise the inflation target, say from 2% to 3%, the bank would tolerate more inflation before acting, which could mean more purchasing power erosion for Canadians on fixed incomes or those holding savings. If the framework gave more formal weight to employment, the bank might cut rates faster during downturns, which would help borrowers but could complicate inflation control. Every choice inside that framework is a genuine trade-off, and publishing the consultation results opens those trade-offs to public scrutiny. If you hold a variable rate mortgage, or you are facing a renewal in the next 1 to 3 years, the framework that guides Bank of Canada decisions is not a policy wonk abstraction, it is the logic behind the rate you will be offered. A framework that leans more accommodative could mean a lower terminal rate in the next cycle. A framework that holds firm on strict inflation control could mean rates stay higher for longer than markets currently expect. Watching how the bank signals its framework intentions over the coming months is genuinely worth your attention. It is worth noting that the act of publishing this consultation report is itself a form of accountability. Central banks historically operated with significant opacity. The fact that the Bank of Canada is surfacing public feedback, and doing so transparently, reflects an institutional shift toward greater democratic engagement. Whether the final framework reflects what Canadians said is the real test, and that answer will come when the next framework agreement is announced. The specific decisions about the Bank of Canada's mandate will be confirmed when the next formal framework agreement is reached between the bank and the federal government. Watch for any signals from the governor's speeches about whether the 2% target will be adjusted, whether employment gets elevated in the mandate, and how the bank plans to handle housing cost measurement. Those signals will tell you far more about the path of Canadian interest rates than any single rate decision. If this kind of structural analysis is useful to you, subscribing means you will not miss the follow-up when the framework decision lands. Educational analysis only, not financial advice.